Hello, everyone. I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today, we're going to dive into a fascinating and essential topic Fraud Examiner Section 2 Law 2.5 Money Laundering. Today's deep dive into the world of money laundering. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are auditor, this journey will shed light on the often complex systems that drive decision making. Money laundering is one of the most complex and veiled forms of financial crime, shrouded in both strategy and secrecy. Imagine this: a river begins polluted and murky at its source, but as it flows through filters, diversions, and vast landscapes, it emerges clear and pristine, indistinguishable from what came before. This is how criminals obscure the origins of their illicit wealth, converting it into legitimate assets that flow seamlessly into the global economy. Let's dive into the intricate world of money laundering, breaking down its methods, impact, and the international efforts to combat it. To start, what is money laundering? At its core, it's the art of deception, a process where dirty money obtained from illegal activities like drug trafficking, fraud, or organized crime is scrubbed clean. But why go to all this trouble? The answer lies in survival and sustainability. Criminals need to use their dirty money without raising suspicions. Through laundering, they disguise its origins, turning illegal capital into something seemingly untainted that can be used for personal gain or reinvested into their enterprises. The scale of this crime is colossal. Money laundering accounts for an estimated 2% to 5% of global GDP, amounting to trillions of dollars annually. Much like trying to measure an iceberg, the visible tip doesn't reflect its hidden depth, making its true scale hard to quantify. However, its corrosive effects on financial systems worldwide are undeniable, making its elimination a top global priority. The process: dissecting the three stages of money laundering. Money laundering operates in three distinct but interconnected stages: placement, layering, and integration. 1. Placement, the initial entry. This is where it all begins, when illicit funds are injected into the legitimate financial system. Criminals face high risks here, as the money is yet to be camouflaged. Tactics such as smuggling large volumes of cash abroad, structuring small deposits to dodge banking thresholds, a method infamously known as smurfing, or even utilizing cash-intensive businesses are common during placement. Picture someone breaking a massive block of ice into countless smaller cubes, making it harder to identify the original form. This stage is where vigilance from financial institutions can yield early detection. 2. Layering, obfuscating the trail. Once inside the system, the launderer moves to the most intricate stage, layering. Think of this as a financial shell game where the source of money is deliberately obscured through a web of transactions. Funds are shuffled between accounts, jurisdictions, or currencies. This includes leveraging digital currencies, operating in countries with weak regulations, or using alternative remittance systems. By the end of this stage, tracing the origin of funds becomes like following an endless maze of mirrors. 3. Integration, clean and legitimate. Finally, the laundered money re-emerges in the legitimate economy during the integration stage. Criminals strategically purchase assets, like luxury goods, properties, or businesses, leaving a perfect paper trail behind. From inflated invoices to shell companies, they carefully weave the illusion of legitimate transactions. Imagine someone expertly sewing patches into a tattered quilt, leaving no visible seams. Tactics and the industries exploited. The ingenuity of money launderers lies in their exploitation of various industries. Bars, nightclubs, and restaurants, often rife with cash flow variability, offer fertile ground. Vending machine routes, real estate transactions, casinos, and even insurance policies round out their arsenal. For example, criminals might inflate real estate appraisals or use casinos to swap dirty money for chips, obscuring the paper trail with winnings. Modern money laundering increasingly turns digital. Cryptocurrencies like Bitcoin, hailed for their anonymity, are now a launderer's playground. Prepaid cards, mobile payments, and even ATMs are cleverly exploited for their versatility and cross-border usability. Trade-based money laundering is another sophisticated mechanism where trade invoices are manipulated, often involving false descriptions or undershipment masking hidden values. Other methods include alternative remittance systems like Hawala, which thrive in anonymity and elude paper trails. Shell companies are similarly crafted entities, legal on paper but hollow in purpose, used solely to conceal ownership and movement of illicit wealth. Even charities and non-profits, institutions built on trust, fall prey to exploitation as criminals funnel and reallocate their funds under the guise of donations. International efforts and the fight against money laundering. Given the transnational nature of money laundering, combating it demands a global concerted effort. Organizations like the United Nations, UN, and the Financial Action Task Force, FATF, stepped in to establish frameworks and cooperation among nations. The UN began focusing on money laundering during its fight against illicit drug trafficking in the 1980s. After 9/11, the focus expanded to target the financing of terrorism. For instance, UN Resolution 1373 mandated member countries to freeze terrorist funds and criminalize aiding terrorism. Similarly, the FATF has introduced international standards to track suspicious activities, penalizing non-compliant nations. These organizations act as the backbone for global AML, anti-money laundering initiatives, orchestrating policies that provide financial oversight, foster cooperation, and standardize regulations. Their work complements national regulations like KYC policies, Know Your Customer, which demand financial institutions verify clients' identities. Coordinated global frameworks tackle the money laundering juggernaut through prevention, detection, and enforcement. The red flags and call to action. Detecting money laundering requires keen attention to detail. Authorities often look for discrepancies in declared values, overly complex financial transactions, or deposits inconsistent with known revenue streams. Trained professionals like accountants and bankers, referred to as gatekeepers, play pivotal roles in identifying anomalies like excessive intermediaries or unexplained shifts in capital. Imagine a giant spider weaving its web ever so delicately. Money laundering is this web. Every string represents a method, every knot a trick to deceive. Cutting through this web requires vigilance, collaboration, and education. As laws evolve and technology advances, so do the criminals. To stay ahead, societies must remain informed, adaptive, and proactive in thwarting one of the greatest financial threats of our time. When we think of criminal empires or illicit activities, one critical component helps sustain them: money laundering. It's the dark art of disguising illegal funds to make them seem legitimate. But in the fight against this global menace, humanity has a powerful ally: the Financial Action Task Force, or FATF. Let's begin with FATF. Picture a global table where representatives from 37 countries and 2 organizations sit shoulder to shoulder. Their mission? To combat money laundering and terrorist financing. Like architects designing a robust blueprint, they craft international standards, principles that protect the financial essence of our world from being polluted by crime or terror. These standards come to life as the FATF Recommendations, a set of 40 measures revised in 2012. They form the spine of effective anti-money laundering, AML, and counter-terrorism financing, CFT systems. Now let's dive into FATF recommendations. And trust me, they're not your average guidelines. First, FATF pushes countries to adopt risk-based AML policies. Think of it as tailoring your armor to match the threats you face. These policies don't follow a one-size-fits-all model, but focus on understanding specific risks, from high-value real estate transactions to small jewelry trades. Another key measure: criminalizing money laundering and terrorist financing, because you can't combat crime without first defining it. Imagine a vast web spread across borders. FATF also wants countries to create financial intelligence units, FIUs, that act like vigilant spiders, spotting and capturing suspicious monetary movements. These units monitor banks, casinos, real estate agents, and even jewelers. They trace illicit assets, conduct customer due diligence, CDD, and implement strict record-keeping protocols. This rigorous system ensures that large sums don't simply vanish into the night without leaving a trail. This framework evolved even further, post-2001. After the tragic events of 9/11 revealed vulnerabilities in financial systems, FATF introduced special provisions. These included stricter laws to combat terrorist financing and strategies to track complex laundering methods, like using shell companies. Shell companies serve as deceptive facades, and breaking through their layers is critical in the fight against financial crime. FATF's expanded remit ensures no stone is left unturned. But here's a question. How do individual countries implement these standards? This is where compliance measures come into the spotlight. Financial institutions worldwide are tasked with designing robust AML programs. Think of these programs as shields for their operations. They must include continuous training of staff, independent audits, and the designation of compliance officers, a team of watchdogs monitoring every move. Enhanced due diligence is particularly crucial when dealing with politically exposed persons, or PEPs. These are individuals in positions of power who might misuse their status, making them high-risk clients. Suspicious transaction reporting, or STRs, acts as another layer of vigilance. By law, institutions must flag transactions that seem out of place, shady, or inconsistent. It could be a sudden $1 million transfer from an account that hasn't moved for years, or a foreign remittance linked to a notorious tax haven. These reports are the bread and butter of investigations, capturing the attention of FIUs and sparking inquiries into possible money laundering cases. Now, let's step back and look at the bigger picture. FATF isn't alone in this battle. Across continents, organizations like the Egmont Group bring together FIUs from different countries, ensuring they share knowledge, collaborate, and strengthen their efforts. Similarly, the European Union provides member states with a standardized playbook, the 6th Anti-Money-Laundering Directive. This directive enforces CDD policies, mandates STR filing, and fosters information sharing across borders. Together, these efforts form an interconnected global network aimed at making money laundering harder, riskier, and less profitable. But what happens when nations don't comply? FATF highlights high-risk jurisdictions, essentially putting them in the global spotlight. Countries like Iran and North Korea face scrutiny for enabling corruption and terror financing. Then there are nations with strategic deficiencies, countries like Pakistan, Syria, and the UAE, which are urged to strengthen their controls or risk economic isolation. Even major financial institutions like the IMF and World Bank get involved, offering assessments and technical assistance to help countries build stronger AML frameworks. After all, the fight isn't just about implementing laws. It's about equipping the global community with the tools to enforce them effectively. From organizations to individuals, everyone has a role to play. That includes businesses like insurance companies, which can unknowingly become laundromats for dirty money. Products like single premium annuities provide a veil of legitimacy for criminals to store and launder illicit funds. To counteract this, insurance companies must adopt KYC or Know Your Customer programs. By scrutinizing customer behavior and conducting background checks, they can flag red flags like large lump sum purchases or investments that seem inconsistent with the client's financial means. Red flags aren't confined to the insurance world. Throughout industries, certain behaviors scream suspicion. Things like sudden policy cancellations, third-party payments, and repeated requests tied to financial havens like the Cayman Islands or Switzerland often signal money laundering. Financial institutions must review these cases, tracing illicit transactions wherever they may lead. So what's the ultimate goal? It's simple yet profound: to align business practices with ethical principles while protecting the integrity of financial systems. And it all starts with the power of awareness, vigilance, and international cooperation. Thank you for watching, and as always, continue learning, stay curious, and we'll see you next video.